Have you ever heard someone say that their mortgage goes up every year? Or maybe you rent a single family home and you're wondering why your landlord keeps raising the rent. You would think that if you get a 15 or 30-year fixed rate loan, that the payments would not change. Kind of like a car loan. Well, that is true, but there is more to your mortgage payment that most first-time home buyers don't know about, and I'm going to cover it in this video. First off, I am Pete Candelaria. I'm a real estate broker associate with eXp Realty here in San Antonio, Texas, and one of the owners of RE Solutions XV, a residential real estate and property management company that loves to educate and help people find solutions for all of their real estate needs. And if that's you, don't forget to subscribe. And if you have specific questions, our contact info is in the description below. So, a mortgage payment is made up of 4 different individual payments that are rolled up in one. This is normally referred to as PITI, or principal, interest, taxes, and insurance. Let's cover each one. Principal. The principal is the portion of your monthly payment that is applied to your loan balance. At the beginning of your loan, very little of your monthly payment goes towards paying off your balance. As you make more payments, you gradually pay more principal than interest until it's paid off. In other words, the principal is the lump sum of the amount you borrowed. So if you bought a $300,000 home with a $50,000 down payment, your principal amount is $250,000. Interest. Interest is charged based on the interest rate you locked in when you close on a loan. Since the interest rate is based on the loan balance, it's highest at the beginning of a loan term but drops as the balance is paid down. This doesn't mean that the payment to the principal and interest change, but how it's allocated over time. This is where the amortization schedule comes into play. You would typically get this schedule with the closing paperwork, and it shows the allocation of payments made to the principal and interest every month for the life of the loan. At the beginning, the majority of the payment will be applied to the interest and very little to the principal. Normally, halfway through, the loan payments will switch, with the majority going to the principal. So if these payments don't change, then what does? The second half of the mortgage payments, because we all know that taxes have to be paid. Taxes. Property taxes are typically assessed annually, and the lender is going to want to make sure that those taxes are paid. Even though the mortgage lien is always the superior lien, the IRS can foreclose and seize a property. They still have to pay the lender the remaining amount owed, but they don't want to go through that whole process. So they set up an escrow account that acts as a savings account. They take the estimated yearly tax amount of the property and divide that by 12 months and add it to your monthly mortgage payment. More to come on that. Insurance. There are 2 types of insurance that is rolled into the mortgage payment. One is homeowner's insurance. The lender will require this in order to protect their interest in the home in the event of damage or theft. Depending on where you live, you may need to purchase additional coverage, for example, flood insurance. Just like the property taxes, the total annual premium is divided into 12 months and added to the mortgage payment. The other type of insurance is mortgage insurance. Typically, if your down payment is less than 20% on a conventional loan, you will have private mortgage insurance, or PMI. This insurance protects the lender from any losses if you default and it has to foreclose on your home. The good news is that you can cancel the PMI once you have 20% equity in the home. FHA loans are different and require an upfront mortgage insurance and monthly insurance payment called MIP that may continue for the life of the loan. It really depends on your down payment. If you have at least 10% down payment, you will pay the MIP for 11 years. If not, you will pay for the entire term. This is where your mortgage payments may fluctuate. Every year, your taxes will be paid and the insurance premiums will be updated. You will get a letter from your lender letting you know that the taxes and insurance have been paid out of the escrow account. There might be an overage or shortage on the account, and you might get reimbursed for the overage, which rarely happens. Or it will give you an option for the shortage of either paying one lump sum or adding the shortage to your monthly payment. If you don't make the full payment for the difference, it will automatically change your monthly amount. And you will need to be careful with this if you have your payment set up automatically at a specific amount that is less than the new payment amount. Now, will this payment change drastically? Not typically. The highest change is normally the taxes, and these can be disputed, but this is a whole other process. There you go. PITI, principal, interest, taxes, and insurance. If you have any questions on the home buying, selling, or even renting process, do not hesitate to reach out to us with the contact information below. We would love to help you find solutions for all of your real estate needs.